Okay, so later we'll look at the strategies to trade the market with the CME Group energy contracts as well. All right, so let's move on. Okay. Okay, what we have here is a chart, the S&P Goldman Sachs Commodity Index. Okay, so this is a monthly chart, and basically what I want to show in this chart is what I call the deja vu. Okay, why deja vu? Because currently we are experiencing in August, September, this sell down in commodities. And actually going back a year back, okay, in August of 2021, we had the same thing, right? So you see here, if you can follow my cursor, all right, last year, August 2021, we also had a sell down, okay, which started in actually May of 2021. And this year, almost perfect timing in the May of 2022, the sell down in commodities again, right? Now, the interesting thing about last year's sell down is the market was managed to actually pick itself up and create new highs. Okay, so it created a high at 787 on the at the GSCI Commodity Index. Okay, by the way, this is also a tradable index on CME. All right, and I also have a note right over here in 2008. There's the previous high, which is the previous commodity super cycle high, which was 866. Okay, so the question is whether we can achieve or surpass this 866 perhaps in 1, 2, or 3 years from now. Okay, so that this question we'll leave for later. But basically, this sell down to August, September is something like a replay of what do you call that, last year's market action. Okay, so whether this will be a temporary pullback or will it turn into a bear market is something that we have to see, right? Whether from here we take another recovery back to new highs. This is something that we need to see. Okay, but what is interesting is even looking at the reasons in last year's sell down. Okay, so last year's sell down in May was basically there was mounting anxiety about slowing economic growth. Okay, and that time, if you remember, the Delta variant was really at large. Okay, and everybody is worried that this Delta variant will impact global economies, right? And then there was this also the China slowdown, and there was this fear of the demand from China softening, right? And right this year as well, we have almost the same reason. Okay, in May, also the mounting anxiety. Okay, of slower global growth. Okay, in fact, I think as time in June and July, the IMF and also the World Bank came up with the forecast. Okay, that in this year or 2023 latest, they will see a recession being unavoidable. Okay, so almost the same reasons. And in terms of the COVID-19, the Omicron variant impact on global economic recovery, especially on the China policy of zero COVID. Okay, the rest of the world, of course, is coming out of it. And today you have news that masks in Malaysia are already optional indoors, right? So we are all coming out of it. But then China have a policy, the zero COVID policy, that has very challenging, in fact, because we've seen more and more lockdowns over the last 1 week in China, and that is impacting not only China's economy but also putting a shadow across the world's economy as well, right? So pretty much the same reason as last year. So whether we can come out of it is something that we have to see over the next couple of months and across the next year. All right, so this is deja vu. So now we move on to the next slide. Okay, so but despite the sell down, if you look at all the other asset classes, okay, this is a chart of all the futures contracts, the major futures contracts across all asset classes, right? So you can see on top of the bunch, okay, where I've circled all of this top performing in the green, okay, from coffee positive until natural gas. Okay, natural gas is long bar. Okay, year to date is up 113%. This is something we'll talk about later. This huge spike in natural gas. In fact, last week's chart, when I charted this, it was up 145%. It's come off quite a lot from there, but still the top performing futures contract in terms of year-to-date gains is natural gas. And going along, coming down the list, you can see heating oil, commodity like orange juice, Brent crude oil. Of course, the US dollar has been very, very strong, right? Rough rice, crude oil, corn, and the whole group of commodities, right? So energy and commodities, if you have put money into energy and commodities, you'll be looking quite good this year, right? Because the rest of the other assets are really actually not doing that well, right? So despite that heavy sell down starting from May this year, commodities and especially energy is still outshining every other asset class, right? So now the thing is this. We talk about this question about $200 a barrel oil. Okay, so during the last the run up to May this year, okay, even the big investment banks in the US are talking about the possibility of oil going to 200. Okay, so whether that's still something of a thought, is it a possibility or is just fantasy? Okay, we are going to look at all the underlying drivers that could possibly push this. Okay, as you can see on March the 7th, 2022, this is where the futures on the WTI achieve a high of 130 and a half. Okay, that's a peak. We've come off. We are now trading around the 89, 90 levels. Okay, so whether it will exceed this high and move to 200 is something, some of these factors that you see on this list that we have to monitor. Okay, so this surge, okay, this year, of course, because of the decline in Russian oil exports due to the conflict in Ukraine, and this is a situation that is still playing out. Okay, it doesn't look like we're going to come to a quick end in terms of the conflict in Ukraine with Russia. Okay, this possibility of a wild card that it will escalate into something bigger. We'll talk about that afterwards. Okay, the other thing is what are the impact from the EU sanctions on Russia. Okay, remember last week the EU decided in the G7 to have oil price cap on oil. Okay, and immediately the Russian announced that they couldn't continue opening up the gas line for natural gas back to Europe. Okay, so there are a lot of things happening in terms of in the Eurozone that we have to watch out, especially the conflict. Okay, now in terms of looking at the US production of oil, okay, whether US production can fill the void, okay, of the Russian oil not coming to the market. This is something that we have to see. We also have to look at OPEC because, of course, OPEC are the largest oil producing countries, right? The OPEC members, what are their constraints? Do they have a restraint in terms of boosting their production? Can they produce more? Okay, and of course the geopolitical crisis. Okay, starting not only in terms of the Eurozone, Russian, Ukraine conflict, but whether there is going to be a flashpoint in Asia in terms of Taiwan, whether there's going to be a conflict. So these are the wild card in terms of geopolitical developments that need to be watched closely, right? So we have to see if anything of these wild cards are going to play out, then the possibility of looking at the $200 a barrel oil could be a possibility, right? Right now, we are monitoring all these situations. Right, so we move on and look at the key fundamental drivers for WTI crude oil. So in terms of looking to trade crude oil, okay, the traders will be looking at all these fundamental drivers, okay, and these fundamental drivers are in terms of the supply and also the demand for crude oil, okay. One of the most followed data is actually the WTI oil inventories, right? And these oil inventories numbers are actually a weekly number coming up on Wednesday, right? So every Wednesday, Malaysian time, 10:30, the EIA we'll come up with a report on the previous week's oil inventory, the ending week's oil inventories. Okay, for today is supposed to be, of course, today is Wednesday. Okay, but due to the Labor Day holiday, the next announcement will be tomorrow. So tomorrow night, 10:30, we'll see the new numbers come out reported. Okay, but the current figures last week, okay, basically in terms of the US crude oil inventories, okay, you can see the chart over here. For the last 3 weeks, is actually been falling, okay, and falling more than expected. Okay, so the previous figure, it fell by 3.3 million barrels, okay, in the week ended August 26, and this is actually much more than the market expectations. Okay, so if you have the inventories fall, that means there's the crude oil draw. Okay, there's a lot more draw from the inventories of the US crude oil stocks, and for the last 3 weeks, this has been happening. Okay, there's been a draw the last 3 weeks. Okay, in terms of looking at this, because every single week the numbers changes. Okay, so you can sometimes looking at these numbers here, go from inventory draw or inventory build. Okay, so on top above this zero, that means the inventories have been building up. Okay, but what you want to see is basically the trend. Okay, the channel trend. So you can see here the highs of the inventory builds have been coming down, and the lows of the inventory what do you call it, draws have been getting larger as well. So this may be implying, okay, in terms of the trend, the stocks are in a downtrend in terms of the trend over the last, say, 6 months or last 3 months. Okay, since the last couple of weeks. Okay, so this is a report that's followed very closely by the traders. So tomorrow night at 10:30, you will see the new numbers basically reporting on the previous week's numbers. Okay, so this is something that is watched very closely by traders. Okay, please note that, of course, please put your questions into the chat box. We will take it at the end of the session. Put in any questions you like on trading crude oil and energy, and I'll answer it at the end of the session. Okay, so let's move on to the next slide, which is talking about production. So just now was inventory. In terms of looking at production, okay, US crude oil production, you can see the line over here, right? Of course, in the year 2020, there was a huge drop, okay? And from mid of 2020, the US crude oil production started to recover. Okay, it is currently still below the pre-pandemic levels. Okay, in the year of 2019 and 2020, the beginning of 2020, okay, that was the peak in terms of the US crude oil production. Okay, at that time, the shale oil production was really in full party mode. Okay, everybody's producing a lot of oil, and US was able, even at the time, to export crude oil outside the country, right? But due to the pandemic, the huge drop, okay, but currently it has been building up slowly. Okay, it's still below pre-pandemic levels. These numbers, the latest official numbers, official numbers on crude oil production is a bit slow. The latest number is still showing June. Okay, so this official number is a bit slow, but in terms of looking at the trend, it's still going up. The June figure is actually the highest official monthly production figure since May of 2020. Okay, so you can see in terms of US oil production is going up and rising steadily. Okay, in terms of looking at crude oil production, there's another metric that a lot of traders actually look at, okay, which is the US crude oil rig. Okay, the active rigs, the crude oil rigs that is currently available and pumping oil. Okay, the latest number that came up for September the 2nd was 596 active oil rigs. Okay, and this number is provided by Baker Hughes. Baker Hughes company shows these numbers and these numbers in September. But you can see the number of oil rigs, active oil rigs, have of course proportionately gone up. Okay, as you saw the US production, oil production as well. Okay, you can see the oil rigs coming up. Now the thing to observe is at this number 600. Okay, if you go into trading economics or you go into the EIA and look at the past numbers, it has actually plateaued around the 600 levels. Okay, the previous figure before September 2nd was 605, right? Previous number 605, and he's finding difficult to break above 605. Okay, so I was thinking maybe the number will go up above 605, but actually when September 2nd numbers came in, it actually took a drop, a quick drop of 9, a loss of 9 active rigs, so 596. Okay, so this has been plateauing, which may be basically implying that the rate of the growth of production may be slowing down in terms of the US production. All right, so this is another metric that's followed by traders. We now move on to shale production. Okay, so shale production was the hero in terms of in 2019 and early 2020. These are the guys that actually produce a lot of oil, brought on a lot of oil production for the US until it became a net exporter of oil, and with something that we need to monitor as well in terms of shale production, and in terms of looking at the EIA drilling report. Okay, and now all these footnotes here is good to note. When you look at this, you can always refer back to all these reports. They come in on a monthly basis. This is the latest one in August 15, called the EIA Drilling Productivity Report. Okay, and in terms of the shale oil production, it's actually projected to rise 141,000 barrels in September to 9 million barrels per day. Okay, so in terms of looking at shale production, the previous month in August, it was 8,908, although it fell a bit lower than what was expected. Okay, but in terms of the EIA, the Energy Information Administration, basically looking at shale production to continue to increase. Okay, one thing you need to look at in terms of the regions. Okay, the biggest region in terms of the US shale oil production is in the Permian. Okay, Permian is the biggest. You can see out of the total, it's contributing 5,000 over in terms of 5 million barrels of oil production per day. So the Permian area is the largest producer in terms of in the US. All right, so this is something that is on monthly figures. So you look for trends in terms of the potential increases in shale oil production. So we move on to another metric. Okay, the other metric is called the DUCs. What are DUCs? DUCs are drilled but uncompleted wells. Okay, so this number is also tracked by traders. Okay, and in terms of looking at DUC, the key theme seems to be underinvestment. Okay, the underinvestment still continue to prevail due to uncertainty. Okay, although the oil prices have been high, okay, for over the last year already, 1 year already. The investment, okay, in terms of drilling, okay, has basically not been not as expected. You know, you would expect with oil being so high that people will continue to drill. Okay, but there are of course certain what do you call that, challenges. Okay, the first is the US labor shortage. Okay, and of course the high cost of production, which hinder a lot of shale oil drillers to increase the investment in new wells. Okay, also because the Biden administration is basically not encouraging fossil oil investments. You know, looking for investments in green energy. So in terms of new investments into drilling and all that, okay, not only the challenge of labor and also high cost, but also whether they are motivated to put money into it, because they already got hit. Okay, they already got hit in 2020, right, when the oil price tumbled, okay, and a lot of them lost money, but now they are making back their money. So basically returning the money to shareholders currently. So in terms of new investments into shale oil production, there's still under investment. Okay, the other problem that they have is also the global supply chain disruption, right? The waits for the materials to build wells and all that takes a very, very long time. So you don't see much of this new drilling of new DUCs coming online. Right, so this is basically, as you see again, in terms of the DUCs, the largest being in the Permian zone, the Permian region. Okay, let's move on. Okay, OPEC, of course, the very, very important impact on the oil markets. Okay, these are the largest oil producing countries in the world. OPEC lost a bit of shine in 2019 and 2020 when US shale oil became a big factor in the oil, oil production in the world, okay? But now with shale oil taking a back seat, the OPEC has become an important factor and player as well. It's not that they have not been, it's just that they've gone into shadows, but now back in the spotlight, okay? So in terms of the last meeting, just 2 days ago on September the 5th, OPEC Plus made a decision in their meeting to cut production by 100,000 barrels per day for October, right? So a 100,000 cut is actually not, in terms of the whole magnitude of oil production, it's not a lot, okay? But it's the stance that they are taking in terms of what they are looking at. Because just a couple of days last week in August 31st, they are one of the committees in OPEC called the Joint Technical Committee. Basically, they're saying that in terms of in 2022, they are going to see a higher than expected surplus, right? So they are in fact revising their surplus up to 900,000 barrels per day surplus, okay, which is an increase in 100K. So basically, maybe they're just balancing up in terms of the production in October by cutting it by 100K barrels per day, right? So the big question now is if there is a looming recession in terms of the global economic situation, will OPEC cut production and continue to cut production? Okay, so that's a very, very important thing to track in terms of the OPEC. So OPEC basically have the meetings in the first week of every month. So the first week of every month in terms of crude oil is very important because decisions will be made in terms of the crude oil production, whether they want to cut production or increase production. Okay, so these are the dates that you want to watch out if you're trading crude oil. Look into the calendar for the OPEC meetings and keep a lookout for what's happening after the meetings, right? So we move on to, China oil demand. Of course, that is on the supply side. China oil demand, China being one of the largest consumers of crude oil. Anything that happens to their demand, of course, will have a big impact on crude oil prices. And you could see actually in the last couple of months, China, due to the lockdowns, okay, you could see the economic figures are not showing that well. In fact, one of the numbers that came up just today is the PMI, the manufacturing numbers unexpectedly fell, right, in month of August. Okay, so things are slowing down in China, and somewhat proportionately also for China oil demand is also slowing down. So in this terms of what you see on this chart is the July imports in terms of crude oil. All right, so basically in July it recovered a bit. Okay, in June the number was the 47-month low in June. Okay, in terms of the crude oil imports, recovered slightly, 0.9%, which is not much actually, right? And this basically due to the destocking activity and basically the slowing domestic demand recovery, okay, due to the lockdowns. Okay, and the last 1 week, the new lockdowns are continuing worry on whether that will continue to bog down on the economic, activity in China, right? Now, in terms of the China imports of oil, traditionally in terms of September, October, it's supposed to recover, okay, because there are festivities then, and this actually in September, October is the peak demand period, okay? So if the demand doesn't pick up in September, October, then the demand for China oil in terms of the imports will not be looking very, very good. Okay, so this is something which is also looked at closely in terms of China oil demand and the economic activity in China, which is basically will consume crude oil if the activity is good. All right, so let's move on. Okay, the other thing that traders look at is the Brent oil WTI spread. Okay, what's the Brent oil WTI spread? Basically, when you look at WTI, WTI is representative of the US oil prices. And the Brent crude is basically the North Atlantic oil, right? Which are basically perhaps more representative of the international market price. Okay, but in terms of the highest traded in terms of futures contracts is the WTI crude oil contract. Okay, so when you talk about US oil, you reference to the WTI, and when you talk about the North Atlantic oil, you're looking at Brent. Okay, and there is a price difference between Brent and WTI. Okay, and normally in terms of Brent, if you look at the chart over here, okay, the blue line is Brent, okay, and the orange line is WTI, and this is the spread. Okay, the spread is the difference between Brent minus the WTI. You can see the spread, and the spread has actually been rising. Okay, this has been rising, and actually in July the 29th, the spread actually peaked to more than $13 per barrel. Okay, and that's the highest in terms of spread since January 14 of 2014, right? So this spread, we have not seen it for the last 8 years. Okay, in terms of the report in the EIA reported this particular phenomenon. Okay, now the thing about this, what this means is, of course, the WTI, the crude oil in US is actually cheaper to buy. Okay, so it's the US oil becomes more attractive to the Eurozone. Okay, so that may be very supportive in terms of the pricing for WTI. Okay, so if the Eurozone were to look at US oil and say, hey, you know, I could buy US oil for cheaper, you may actually increase the exports from the US. Okay, and also in terms of Asia, okay, if US oil WTI is cheaper, it could actually incentivize Asia to what they call that, to buy less Brent, and because Brent is more expensive, right? So Asia may be import less of Brent due to the high prices. Okay, so this is something that we also need to monitor in terms of the spread, right? So currently it's trading near the highs. Okay, now those are the very specific what do you call that, crude oil related data and numbers that people are monitoring, or the traders are monitoring. Okay, but the very big picture thing, we have to look at the global economy. Okay, this will dictate, of course, demand for crude oil. Okay, and this is the IMF report. Some of you may have read it. Okay, this is a report came out for July 2022. Talking about the next half year, what do you call that, global outlook. Okay, so basically it's not a good picture, right? It's gloomy. The headlines say gloomy and more uncertainty. Okay, basically because of the economic downturns both in China and also in Russia in Q2. Okay, the war in Ukraine. Okay, the supply disruptions. Basically, the worldwide inflation still continue despite the prices coming off from what they call that, the commodities, right? And tighter global financial condition in terms of US and also global interest rates are rising. Okay, these are squeezing the cost of lending to do business. Okay, this could basically induce a debt distress. Okay, especially in the emerging markets and developing economies. Okay, so they are also monitoring the COVID outbreaks in terms of China and the lockdowns in China. Okay, as this will further suppress the growth in that part of the world. Right. So the other part is, of course, the geopolitical fragmentation. Okay, this is where is a big worry as well. The geopolitics, okay, could actually impede global trade and cooperations. Okay, with all the sanctions and countries, what do you call that, polarizing among each other. You could see global trade and cooperation being less. Okay, so these are the major worries in terms of what is reported in the IMF. And in terms of looking at the numbers, you could see the growth projections are down. Okay, this is their second downgrade this year of global growth for this year in 2022. Okay, and in 2023 they don't really have a very nice outlook as well. That 2.9% in terms of growth across the world. Right, so in terms of advanced economies, you see even in 2023 only 1.4. So it's not really great. They foresee a bit uptick in the emerging markets and developing economies for 2023, but actually not much. So in terms of looking, their main statements is the risks to the outlook are overwhelmingly tilted to the downside. So they see a lot of downside for this year as well as for next year. Right. So in terms of also the World Bank came out with a report earlier than IMF. Also, basically, they downgrade the expectations for global economic growth. Okay, from 5.7% in 2021. They're looking at 2.9% this year. Okay, basically mentioning a recession is unavoidable for many countries. Okay, one thing I picked up from it, which is very important to look at, is this statement that even if a global recession is averted, the pain of stagflation, okay, stagflation could persist for several years. Okay, so this basically stagflation is you have a very slow growth in terms of economy, okay, and still continue to have inflation, high prices in terms of your commodities. So that is a issue, a very big issue. We will revisit this issue in the next couple of slides. Okay, so what is the next catalyst? Okay, in summary, in looking at crude oil, we look at the demand, we look at the supply, and all the other factors. Okay, these two are the big things that could happen going ahead in the next 6 months or the next 1 or 2 years. Okay, the first thing, as World Bank has said, stagflation. Okay, stagflation is a very difficult what they call that situation, economic situation, to solve. Okay, you basically have sluggish growth and perhaps even high unemployment. Okay, because of the economy is not growing, jobs are not being really created because of the slow economy. But you have inflation continuing to soar, and this is a very difficult situation. Economies and central banks find this very challenging. There's no real medicine for stagflation. That's why the World Bank said stagflation may persist for years, because there's no real medicine if you have this problem. Okay, and that's not a very good problem to have. Okay, the other thing is the geopolitical situation. Okay, so that caution there, that big caution yellow sign there is World War III just ahead. Okay, so are things going to turn bad in terms of the Eurozone? Is it going to escalate into and bring other countries into a war, not only in Ukraine and Russia, but bring the other countries in NATO into a war? This is something that fear to see, okay, but it's something of a wild card that we have to really watch out for. Okay, and other flashpoints, okay, Taiwan issues and all that. This is something closely watch. Okay, if it goes into World War III, then things are going to be very different. All right, so these are the possible things that looking ahead in 6 months, 1 year, 2 years down the road. Okay, so now we move on and look at the drivers for natural gas. Okay, very interesting, natural gas. Okay, you saw the huge bar. Okay, as of this noon today, it's up 115% year to date. Okay, let's see what's happening in the US natural gas prices and what's happening in that sphere. Okay, so this is the chart of the Henry Hub natural gas futures. Henry Hub is the main hub for natural gas for US. Okay, this is a weekly chart. Okay, so it's already recovered to new highs after the sell down, right? So of all the commodities, natural gas is one of those that have created new highs after the sell down, right? So in terms of looking, this red line is the 200-day moving average. So basically now it's in, of course, still continue to be in a bull market. All right, we will revisit these charts on the 21st of September when we do the other section on crude oil and energy, where we'll talk about the phases and look at the technical analysis. So join us, don't forget to join us on the 21st of September. We will talk about the more on these charts. Okay, so this is a quick look for you in terms of the Henry Hub natural gas futures. So currently trading around the $9 levels. Okay, I want to just quickly scope out into another chart. Okay, let me show you another chart of the European oil prices. Okay, which may shock a lot of people. Let me show you another screen. Let me stop this and show you another screen since we are here. Okay, let me show. Okay, I hope you're seeing my screen here. Okay, I want to show you this screen. Okay, let it load for a while. Okay, this is the Dutch TTF. This is the benchmark natural gas price. You can see the difference. The orange one. Okay, hold on a second while it reloads. I hope everybody is seeing this. Okay, if you don't see it, put a comment in the chat box. Okay, it's still loading. Okay, So if you see two lines here, okay, the blue line is the benchmark for European prices, the Dutch TTF they call it, okay, and that's the hub for natural gas, and that's where the benchmark price. Look at the price, okay. This is already normalized to the same unit of the dollar MMBTU, right? It's 69 US dollars per MMBTU, and you have the natural gas at 777. So this is the huge difference between European gas prices and US natural gas prices. Okay, and if I show you the Asian prices, okay, which they looking the Japan Korea marker, okay, this the JKM is where you see the prices. You will see the huge difference between the US natural gas and also the US dollar terms in terms of MMBTU of the Japan Korea prices. Okay, so almost right, how many times of the price in natural gas compared to US natural gas. Okay, this is something is really, if you're outside the US, you're really in deep pain, okay, in terms of the Eurozone in UK and also in Japan, Korea, right? So this is something that is so different in terms of the pricing. Okay, now the thing is this, later we'll look into how natural gas is US natural gas is going to react to this phenomena of the international prices being so high. Okay, so let's get back to the charts and see. Okay, let me get back to the charts. Okay, all right, so we're back at the charts. Let's go in and talk about. Okay, can you see this? Okay, is everybody seeing this?
Yes, we are, Mr. David.
You are? Okay, thanks so much. Yeah, because I because I keep flipping into different screens. That's why I need to confirm that you're looking at this. Okay, let's move on. Okay, so let's look at the key drivers. Okay, again, if you're looking at the key drivers, of course, in terms of inventories, also is very important for gas. Okay, so this is another figure that is tracked on a weekly basis as well. This is gas storage inventories. In terms of US natural gas, actually rose 61 billion cubic feet in the week ending August 26. Okay, so you can see over here, this is an interesting chart. I wanted to show you a chart across the last 4 years, because in terms of the natural gas stock, there is a cyclical, what do you call that? There's a seasonal pattern in terms of US natural gas stocks. Okay, so you can see that in terms of US before summer, prior to summer and prior to winter months, there's always a build. Okay, and of course in summer there is the build, because summer people will use natural gas for air conditioning, right? So there's a build and there's a use, and then after that, in terms of the winter, there's a large draw in terms of the usage because of the winter, right? So in terms of the monitoring the temperature of the homes, natural gas is a very important component, whether in terms of cooling or in terms of heating the house. Okay, so that's why in Europe, okay, it's now they are frantically stocking up on gas in terms of the gas reserves and storage, because winter is coming, and the natural gas is a very important component in terms of heating the homes, right? So in the US, it's the same as well. So you can see a seasonal draw, okay, from autumn onwards until the spring. Okay, same for every year. Okay, so that's the pattern. Okay, so which means to say that the demand for natural gas will increase during the winter months, and of course there's some draw during the summer months. Okay, so prices tend to be supportive during that time as well, in terms of the winter month, where there's a large draw in terms of the inventories. Okay, so this is a seasonality in terms of the storage levels for natural gas. Okay, so this is something that you need to observe. Okay, so we move on from gas storage. We move on to, in terms of looking at the bit larger numbers, I want to show you this chart to show you the trend. Okay, so this is the EIA forecast and the estimates of the storage inventories. Okay, so this is a report came out in August. okay, and in terms of the inventories ended July. So these are the big picture numbers, which is in the you can see this the brown, dark brown line, okay. This is the storage and inventory level, okay. And you can see between zero, there is this scale here, 0, 500, 1000, and negative 500, and you can see over here right now the inventories are actually below the 5-year average. These are the 5-year averages, and it's below, okay. And this trend has been coming down. So basically, in terms of the average price, inventories is 12% less than the 5-year average. Okay, so basically the stocks are depleting, right? So in the rising prices in the recent months, actually also because of the very hot summer in the US as well. So a lot of air conditioning, a lot of usage in terms of natural gas. Okay, and where does natural gas come from? Because the natural gas is used for electricity production. Okay, it's not like they're using natural gas to cool the home, but natural gas is used for the production of electricity. So a consumption of more electricity will mean a consumption of more natural gas as well. Okay, so in terms of inventories, 12% below 5-year averages, and the trend seems to be coming down, right? So those are supportive in terms of supportive of natural gas prices. Okay, now in Europe, Asia, just now you saw, okay, the demand, there has been a real shortage in terms of Europe and Asia, and you saw the prices just now in the Dutch TTF and also at the JKM, Korea, Japan numbers. The prices are way so different. Okay, but what is interesting to note in terms of what is the effect of those shortages is the amount of LNG gas. Okay, LNG, of course, is the liquefied version of natural gas. That's how you import natural gas, by liquefying it and putting into tanks. Okay, so if you track, okay, you go in and look at the EIA numbers and track the number of what do you call that, LNG in terms of million cubic feet being exported, you can see that and since it's going on a very what do you call that, big growth, okay, very strong growth. Okay, in fact, in the first half of 2022, the United States became the largest LNG exporter in the world. Okay, because of the shortage in Europe and Asia, and that demand could continue to go on as Russia basically turns off the tap to Europe, the gas to Europe. Okay, so they need to scramble. Europe need to scramble for their gas. Okay, so in terms of LNG imports into Eurozone, there could they'll be probably looking at US again. So in terms of looking at that, right, there's this huge price difference between the US natural gas and the European prices. So you could see continued demand pushing prices of natural gas in the US. Okay, that's a possibility, right? So in terms of the forecast of LNG exports, okay, you're looking at a 14% in terms of increase from 2021. Okay, that's what the EIA forecast is in terms of exports, right? So exports are being driven by international shortage. Okay, the other thing is the use of natural gas for electricity generation. Okay, now traditionally a lot of the electricity generated in the US are from coal-fired plants. Okay, so because coal-fired plants are dirty energy, right? So as the move to green energy and cleaner energy, you see a lot of these coal-fired plants are being retired. Okay, so these numbers are the, what do you call that, the retirement in terms of the coal-fired power plants. Okay, basically in terms of the total retirements of capacity in 2022, 76% of the electricity generating what do you call that retired in 2022 will be the coal-fired power plants. Okay, so coal, you can see here, these are going to be retired. Okay, now after you retire these coal power plants, you need to have a replacement. Okay, so what is the replacement? So the next slide will show you the replacements. Okay, so new capacity, these are new capacity in terms of the other new capacity coming online in 2022. Okay, so for the first half of this year, already 15 gigawatts have been added. Okay, and you can see the various components in terms of the colors. Okay, natural gas is one of the big components. Of course, solar, wind is two big components as well, but natural gas is a big component. And towards the end of this year, they're going to see basically 9.2 gigawatts of this power, the additional power, will come from natural gas. Okay, so natural gas production in terms of electricity will be one of the key components as well. Okay, so these are going to be supportive of natural gas because it's being used for electricity, what they call that, generation, right? Okay, this is basically the number for specifically for natural gas as for electricity generation. So one thing to note in terms of looking at natural gas in July, okay, because it's so hot in July, okay, basically the demand for electricity and for air conditioning is very, very high. You can see record high set in terms of the US natural gas generation in terms of megawatts in July. A lot of this electricity generation from natural gas in July, right? So reach a high of 6.37 million megawatts hours in July 21st. Okay, so this has been used a lot for electricity generation as well. Okay, so these are very important things to watch for in terms of natural gas. Right, so after looking at a very comprehensive look at the WTI, crude oil, and also natural gas factors, let's see how we can explore some of the trading opportunities. Okay, in terms of it looks like in terms of the natural gas, it's going to be supportive and the trend is going to go up. Okay, in terms of oil, there's still factors to be considered. Okay, in terms of what are the wild cards that possibly can be played out in the next couple of months or in next year. So how do we explore, how do we take advantage of these trends? Okay, so the first, of course, let's look at how we can trade some of the contracts available on CME. Okay, in terms of the WTI crude oil, okay, the CL contract, this is the most highly traded futures contract on crude oil in the world. Okay, the WTI, or what you call the West Texas Intermediate light sweet crude oil. Okay, it's a very high grade crude oil. Okay, that's why it's called light sweet. Is it actually sweet? Okay, the miners actually said, the old miners, they taste the crude oil, they use oil, they say it's actually sweet. Okay, very interesting. Okay, stored and distributed in Cushing, Oklahoma. That's where the main hub is. Okay, and of course this is the global benchmark for futures for oil in the US. Okay, a lot of hedgers, of course, a lot of speculators use this contract. Okay, now note this, this is a 1,000 barrel contract, so this is a big contract. Okay, and to trade this contract, it's 8,600 in terms of margin. So futures margin to trade one contract of the WTI is 8,600. Okay, this has increased due to the volatility, right? When I was trading it, I used to trade this contract as well. Now I trade the smaller contract we'll show you later. Okay, it's very, very active contract. This is the main contract. Okay, everybody trades this contract. Okay, and you can see, look at it, every day it's almost 1 million contracts traded on a daily basis. Okay, so this is the main contract. All right, but for those who what has been coming out and what's been very active is this new contract launched a couple of years back called the micro WTI. Okay, so the micro WTI is a smaller contract. It's only 1/10 the size of the big brother, right? So instead of 1,000 barrels, you're trading 100 barrels of oil. So it's more affordable in that sense, right? So this is the fastest growing energy product traded today in terms of CME products and also across the world, right? Close to 20 million contracts have been traded since launch. Okay, and what is interesting about this contract is nearly 40% of the volume actually come from outside of the US. Okay, so even in the Asian hours, is a very active contract. Okay, micro WTI. So let's talk a bit about micro WTI. Right, so as we said, it's 1/10 of the big brother, so 100 barrels. Okay, the minimum tick is 1 cent per barrel, so the minimum movement is 1 tick per barrel. Okay, so in terms of value of $1, let's say for example, if you bought a contract of the MCL, the micro crude oil, okay, and the crude oil went up by say by $10. Okay, so $10 would mean how much? $10 would mean every single dollar would every single tick. Okay, if you have 100 barrels, because this contract is 100 barrels, if you move up by $1, it's $100 profit for you. If you move up by 10, of course, it's $1,000 profit. Okay, so very easy to actually account how much profit you make in terms of P&L. Later, I'll show you an example. Okay, now this is a very popular contract, okay, even among Asian traders, okay, because number one, it's more affordable, right? In terms of how much you need to come out in terms of the margins to trade this contract, it's $860 just to trade this contract. Okay, so for those of you who are familiar with our Malaysian contracts as well, if you trade the crude palm oil contract, right? So a crude palm oil contract is 11,000 ringgit, right? So 860, the micro WTI is actually cheaper in terms of trading this particular contract, right? So this one another alternative if you look at trading crude oil. Okay, of course, in terms of the final margins from the broker, please consult Penanga Futures for the actual margin. Okay, they may differ from broker to broker. This is the exchange margin required. Okay, so consult Penanga for the final margins. Okay, but this is just for you as a reference, as a more affordable. It's 1/10 in terms of the margin required to trade this contract. Okay, so basically this contract expand all opportunities to all types of traders, right? So the smaller traders also can participate in the movements of the micro WTI, the WTI crude oil prices. Okay, so currently it traded about 126,000 contracts per day, so it's very active in terms of year-to-date volumes on a daily basis. Right, so a quick comparison in what we have in terms of the CME WTI crude oil suite. We have the micros, all right, we spoke about that. We actually in between we have E-mini, right? The E-mini is a 500 barrel contract as well, right? But in terms of popularity, the WTI, the big brother, is very popular, and as well as the micro, this is very popular. Okay, so this is just a quick comparison between the three contracts. Okay. Let's talk about the Henry Hub natural gas. Okay, now the natural gas, this is of course a large contract. Okay, natural gas, this is the big brother natural gas. Okay, we hope for some new smaller contracts as well, but this contract is the most active. 10,000 MMBTU. Okay, so one contract size 10,000 MMBTU. Okay, and this is the largest physical commodity. Sorry, the third largest physical commodity futures contract in the world. Okay, so this is very liquid, very deep, a very liquid 24-hour access to this commodity futures contract. Okay, of course, it's a large contract. You can see the margins are so quite expensive. It's 12,400 indicative margin of the exchange. This is required by the clearing. So this is a large contract. Okay, of course, each tick. Okay, of course, 3 decimal place. Okay, this minimum tick is 3 decimal place per MMBTU, $10 per tick. Okay, for those who have a larger appetite and love to have a position in natural gas, this is the contract that you want to trade. All right, so this is the Henry Hub. Okay, so just a quick example before we go to Q&A. We talk about the P&Ls or how to trade. Just give you a quick example on micro WTI, the MCL. Okay, suppose October micro WTI MCL is trading at 100. Okay, of course now it's trading lower than that, but let's assume it's trading at 100. So you bought one contract, you're bullish on say the WTI, you buy one contract of the MCL at 100. Okay, now MCL rises to 102. So how much profit do you have? Okay, so from 100 it rises to $2. All right, so you have a $2 profit per barrel of the WTI. But this contract MCL is 100 barrels. So you just multiply $2 multiplied by 100. So you have a profit of 200. Okay, it's quite simple to calculate. And of course, if you bought and the market went down by $2 to 98, then you would have a loss of $200. Okay, quite simple to calculate. Now, if you're shorting, okay, you're bearish on WTI, you could sell, okay? So the beauty of the futures market is you could actually go short. So you sell micro WTI MCL, say you sell at 100 and it prices drop to 98. So you have a gain of $2 per barrel, a 100 barrel contract on the MCL, you get $200 profit, okay? Very simple to calculate. And of course, if you went short and market goes up, then you would have loss, right? So if MCL rises to 102, you have a $2 loss in your account per barrel. You have one contract, that means it's $2 times 100 barrels is $200 loss. Okay, so it's quite simple to actually calculate the P&L for trading the MCL. Okay, so that is, and this is a quick example to show you how to calculate both the trading scenarios in bearish and bullish markets. Okay, before we get to Q&A, which Chirag is going to get ready, a quick heads up on this newsletter available on CME. Okay, if you have your scanner, you can scan this little T-Rex over here. This is a trading room analysis, which is a what do you call that, a newsletter which you can receive in your inbox. Go in and subscribe. The latest issue is August 31st. There'll be one coming up very soon. It comes out twice a month, okay, and gives you a lot of ideas on the various trades, not only in crude oil, gas, there are other contracts on CME. You find a lot of tradable ideas from this newsletter. So I already encourage you to go to this. If you don't have their scanner now, you go into CME website and just check out Fresh from the trading room, right? If you you type into the search box on the CME website, you can get to this newsletter. Sign up for it every month. You have 2 of these newsletters that will give you very good analysis and also actionable analysis that you can use for trading. Okay, so now let's get on to Q&A.